Hello, welcome everyone to the Mortgage Hacks. We appreciate you tuning in here. What we're going to do is we're going to go over a few items that are going to help you prepare not only yourself, but your clients as well moving forward into the new market that we're going to have into 2023. This list here, this playbook was put together by our VP of Lending, Laura Lynn Ball, Jason Abrams, and Gary Keller himself. So very, very smart, forward-thinking individuals got together and put this together. And once again, this is something that you can use moving forward. That's going to arm yourself, your clients, help the market that you're in, everything else moving forward. So Jill Jackson is here with me as well. And we're going to go through this together. Yeah, she's going to help compensate with everything. So,
and I'll just add too. So at a regional meeting in Toledo, Keller Mortgage was there and speaking about this Mortgage Hacks playbook. And I have to tell you, I learned things that I never necessarily knew as an agent. I'm embarrassed to say I've always kind of referred people to their lender and say, ask your lender that question. But we need to, as we are going from a fast-paced market to a skill-based market, we need to equip ourselves with the tools and we need to be more knowledgeable. So you can take it away, Matt.
Yeah. So one of the things that they talk about in the playbook, one of the first things is passengership versus partnership. So what that is passengership is when the market is strong, aka the mortgage market and the real estate market in 2020, 2021. Rates were super low, houses were flying off the shelf. Everyone's just kind of a passenger along for the ride. You really don't have to really sharpen your skill set that much. It kind of sells itself. Now, a partnership is when the market changes, which is what we're seeing right now. Rates are higher. Houses are sitting on the market a little bit longer. You need a little more of a strategy moving forward. That's where a partnership comes into play. And that's what we're trying to build here is a partnership. We're trying to build a partnership with the market center here and a lot of market centers moving forward. We're going to show you once again how to strengthen what you're doing right now to help yourself moving forward. So you don't have to, kind of fall by the wayside and, and have your business suffer. So I'm going to go through a couple things here real quick. I'm going to go down if I can. There's the passengership versus partnership. If you can see that on your screen, you can read right there. Once again, when the real estate market is strong, is the passengership versus partnership when you have to kind of go along here. So scroll down a little more if you can. So that we have multiple steps here. I believe there are 7 steps. Number 1 is understanding the market of the moment, which is what we're in right now. So we're going to talk a little bit about that. Understand the current mortgage solutions that are available. That's something we're going to dive into that you're going to find very useful. Understanding mortgage product hacks. Once again, kind of 1 and 2 or 2 and 3 go along with each other there. Number 4 is understanding mortgage hacks for current homeowners. We'll go over that. That's more along the lines of refinancing once the market shifts back into a strong model where rates go down. So we'll go a little bit over that. Know the mortgage products that your lenders offer. Once again, we'll go over what Keller Mortgage has to offer your mortgage lender that you have, your in-house lender. We'll let you know what those are so you can better understand those. Number 6, market and advertise mortgage products and hacks. Once again, we'll touch on that and market mortgage products and hacks to your database. So scroll down a little more. So we're going to go over step number 1. Understanding the market of the moment. So Jill, do you have any insight on the market of the moment right now, kind of what everyone is looking at as far as where we are?
Well, every single person, every client, every human being says, should I wait to buy a home? Are rates too high? Are they going to come down? Are they going to come up? And one thing I said actually during our ALC meeting, I don't know if you would agree to this, Matt, but Mortgage News Daily is an app that I recently downloaded, and I would encourage all of you agents to download it as well. That's understanding the market of the moment because that rate changes every single day.
Sure does, every day. And I agree with you. So anything that you can utilize out there that gives you current, up-to-date information on what's going on with the mortgage market is useful. There's plenty out there, and that's definitely a good one. So I agree with you. All right, so this one is going over the questions. This is more along the lines of what Jason Abrams and Gary Keller put together, asking your clients what the questions of what to ask them. The data is abundant. It's all over the place out there. So all you have to do is just tap into it and utilize it. Local and national events They talk about with KWRI hosting their regular events. You know, they get advertised out there. Just, you know, go to them, utilize them. They have a lot of good knowledge there and a lot of good information to help you move forward as well with the market. So that's all that is. And this playbook, by the way, we're going to send it out to everybody, make it available so you can look through it. And obviously, you know, if you have any questions on anything at all, you can give me a call, give Joe a call, anybody, and we'll go over with you. So
I think step 2 here is one of the most important, and Matt, we don't have to go through every single step, but just whatever we have
Right.
time for. But step 2, understanding the current mortgage solutions available. So this, I think, is probably where we can spend most of the time. And what really opened up my eyes is, I was joking, you know, I've been in the business 5 years, and until 6 months ago, I've never had a client have to use an ARM. And I kind of understood what it was, but I didn't really. So understand what ARMs are, understand what buy downs are, what a 2-1 buy down is, etc. And you can probably explain more.
yeah, so the ARM product, the 2-1 buy down product, all of those are geared towards the market that we're in right now currently. And it gives your clients the payment flexibility and relief so they can purchase the house that they want to buy when rates are high. It gives them the ability to get in a comfortable payment range that they're comfortable with, and still buy the house that they want to purchase. And then once rates come back down, because everything is cyclical, everything's going to come back down eventually. And when that does happen, they can refinance, get into a fixed rate mortgage at that point in time, and literally never have to touch it again, which is fantastic. So,
And Matt, if somebody who is watching does not know what a buy down is,
Mhm.
could you explain it in layman's terms?
Yes. So a 2-1 buy down, what it does is it kind of gives you the best of both worlds for both your buyer and also the seller as well. So I gave the example of a $300,000 house. Let's say your client is looking to buy a $300,000 house. Instead of offering a price that's lower, say $290,000, instead of doing that, you could actually go to the seller and say, listen, we'll give you what you're offering, $300,000, but give us $10,000 in seller concessions or seller credits. And what your buyer can do with that is they can utilize that for a 2-1 buy down. What the 2-1 buy down is it gives you a rate that's 2% lower than the current market rate for the first 12 months. And then after the first 12 months, the second 12 months, it's going to be 1% lower than what the current market rate is. And then year 3, it goes up to what the regular current 30-year fixed interest rate is for the remainder of the term. So it's not an adjustable where it fluctuates, you know, forever until, you know, they refinance or sell the home. It just gives them payment flexibility for the first 2 years to once again buy the house that they want to purchase. And then it also allows the seller and also the community to not lose value, because think about it. If you give a lower value of $290,000, that brings the value down of the next house and then the next house after that. This keeps the values where they are currently, doesn't drop the market value for the houses in the area. So it protects everybody moving forward. So it's a really good product. We utilize it a ton in our market on Strongsville and also in Canton. So yeah, we should utilize it here too, because it's fantastic.
Did you have a question, Rick?
Can I ask a question?
Sure.
So your number, the example you just used, a $300,000 purchase price, ask for $10,000. Is that a real number? That 10 is what, I guess my question is, how do I know when I'm writing the offer, if we want to take advantage of a 2-1 buy down, how much, because it has to be seller's money, right? It
Correct.
can't be,
It's funded by seller credits, correct?
so how do we know how much we need to ask the seller for so that we're not short?
Mhm.
And I don't know, there's too much. Can we use that extra for other closing costs?
Yes. So great question. I use $10,000 as just a general round number, so we could use that for example purposes, but you are correct. It's different for every house. So the purchase price is going to determine how much you need in seller credits to make that work. But let's say that it only takes, and I'm just going to use round numbers again. Let's say it only takes $5,000 to fully fund the 2-1 buy down, but you get your client a $10,000 seller credit. The $5,000 for the 2-1 buy down will go towards that, and then the additional $5,000 is used towards their cash to close. So once again, they get the best of both worlds there. Everyone wins.
So how do we
That's great.
know if is the actual cost of the 2-1 buy down a function of the loan amount? Or
Yes.
is okay.
It's a function, and that's something that when we're kind of working out the numbers, if it's something that a client is interested in, what I do is I put the numbers in the system, let you know exactly what the number is, and then that's kind of what we go by there.
So as an agent, is this something we should be asking you at the time of pre-approval? So
If it's something that the buyers or that you're interested in, then yes, absolutely. Let me know that that's something that might be on the table. I'll let you know what that number is, so you have that in the back of your head. You don't have to do the 2-1 buy down. You can do just a regular, 30-year fixed for your buyers with no seller concessions at all. But if you want to at least know what that number is, then I can give that to you, so moving forward if you write an offer what you need.
there's not a simple X% of the loan amount. It's not something I can figure out what the cost of the 2-1 buy down is gonna be.
I'll look
while
into
we're
that.
Sitting there writing an offer at 11 o'clock at night and we don't want to call you.
I don't think it is. I think it's based on a different formula, but I'll look into that and see if it is, then I'll update you and I'll let you know what that is. So as of what I know right now, I think it's a multiple factor thing that determines that amount. But once again, if there is a simple percentage, then I'll let you know what that is. I'll
I
update you.
got another question about
Sure.
how do we present to the sellers in an effective way to do a 2-1 buy down, because in the last couple of years, 2.5 years, if your buyer's asking for closing costs, the seller thinks you're maybe not the best buyer out there, right? If I'm offering 290 with no closing costs and you're offering 300 with 10,000 closing costs, for some reason, a seller thinks, well, the 290 with no concession is a better borrower, a stronger borrower, which you and I know that may not be the case.
Right.
But since that's been how sellers have been looking at it for the last couple of years,
Mhm.
how do we present it to a seller that in a way that says, yeah, they're asking for 10,000, but you're netting, and what's the best presentation so that we don't scare a seller to think that somehow this is a weak buyer?
That's a good question. I don't know how you guys present those offers, but I will tell you that seller credits are in this market right now are getting accepted a lot. Whereas a year ago, it was like a dirty word and it wasn't even like you were pushed to the side. That's not the case right now. I know that a couple agents that use this all the time, what they say is, hey, listen, I'm going to use the same example of the $300,000 house. They'll go to the seller and say, hey, listen, our client only thinks it's worth 290 and that's what they're willing to pay. You guys have it at 300. Instead of us offering you 290, we'll offer you 300 full asking. You give us 10,000 in seller credits. Your sellers are netting the exact same amount, literally the same amount, but you're helping our client and you're also going to be, keeping the values in the neighborhood strong as well for future. So how you kind of frame that to where it's going to be.
I don't think a seller cares about the future value.
Well, I know they don't care about, the future, potentially the future value, but yeah, once again, I don't know. There's a way that you can kind of frame it to where you can let them know that your sellers are very strong. They don't need it. You can say, hey, listen, there's a specific program out there that they want to take advantage of that requires seller credits. So that's why we're looking for it. It's not a matter of them not having the money, they have it, but there's a specific program. You don't have to go too deep into it. But if you say that, that'll probably get them off your back as far as the strength of the buyer. So hopefully did you agree with that?
Yeah, and I would say good rapport with the listing agent, letting them know beforehand, hey, it's going to make a lot of sense for my buyers to be using a buy down. And I would ask, if we come in at this and have this buy down, do you think we can get something together?
Yeah, so I haven't heard of any pushback with that yet. Like I haven't heard of anybody saying, hey, it's showing your buyers weak. That hasn't been something that I've personally encountered. However, if you do encounter that, if you want to go a little deeper and say, hey, listen, they want to do a 2-1 buy down product, it's, you can tell them what it is, what they want the money for. Not that they need it, they have it, but that's what they want to use it for. So, the seller's going to get the same amount, whether you come in at 290 with 0 seller credits or 300 with 10,000. So it's all one and the same. It's just getting there a different way and helping everybody out.
And when we write it, do we have to write anything special about
No.
2-1? We can just say $10,000 credit towards buyer closing costs, prepaids and points.
That's it. Yep. Very simple. Yep. Every single time.
So if you missed that on Zoom, if you didn't hear, you would just, as you're filling in your contract, you would just put that amount in. If it's $10,000 for the buy down, you would put that where same place you would put seller paid closing costs.
Correct. Yeah. You don't have to go too deep into it. Just say towards total cash to close or closing costs, prepaids, and whatever the case may be. So that's it.
Yep.
All right. So
All right.
I'm going to move on a little more. let me see, if we can go down a little more. Kira, let me see where we are. Okay, so understanding mortgage product hacks. So these are some of the products that you're gonna want to tap into and utilize in a market where rates are higher. These are the ones that we kind of target here as well that can help your clients. So number one, the buy downs that we just spoke about. Now there's two different types of buy downs, and I'll let you know what the other type is because we covered the 2-1 buy down. So buy downs are number one. Number two, a 5-1 arm, which is different from a buy down, and we'll go over the difference there as well. 15-year mortgage, very straightforward. That one's self-explanatory. A 40-year mortgage, which you'll see on here, is not something that is going to benefit anybody. So if you see a 40-year mortgage out there, stay away from it. My personal opinion, you'll get that as well. That's kind of like a, an urban legend, so to speak. Number 5, a lock and shop through Keller Mortgage. That's a very popular and very strong product that we have as well right now. A lot of other lenders have it. Once again, we Kellerize it and make it better. So you'll see what that is. Number 6 is seller financing. That's a little bit of a, you don't really see that often, but I'll let you know what it is just in case. Trust deed and wraparound mortgage. You'll never see that. That's something that you're never going to utilize. And home buyer assistance programs. That's something that we will go over that you might utilize. So buy downs. So once again, we covered the 2-1 buy down, how that works. The other buy down is if you get seller credits, once again, using the same example of $10,000, you can actually use that $10,000 and just buy the rate down permanently. So I personally recommend doing that when the market shifts and the rates are lower, because more than likely they're never going to refinance the house ever again. So once rates do drop down, so let's say hypothetically in the high 3s to low 4s, I would recommend doing something like this at that point in time, because doing it right now when rates are high, if they buy it down permanently, let's say they buy it down to 5.5% or something along those lines, rates are more than likely going to drop below that anyway, and they're going to refinance, so they'll never see the break-even point. So I wouldn't recommend doing that now, but once we shift into a different market, absolutely, this is something that can benefit your clients. So that's one way to do the buy down. The other way is the 2-1 buy down, which I definitely recommend, because if they do refinance within that 2-year period, they actually get the money that wasn't used back into their account. So they get that money back. There is no break-even period on that.
So 2-1 available, or either one of those buy down programs available on outside of the 30 and the 15, like a 5-1 arm.
Yeah.
You can still use it on other one product.
Yes, you can. Yeah, you can buy it down there too. All right, so let's go down a little more. All right, let's go scroll up a little bit if you don't mind. Beck. No, so yeah, there's a 3-2-1, but we don't have the 3-2. We don't have the 3 portion. We have the 2-1. The 3 portion, it takes more seller credits. So we figured we would just skip the 3 part because it would require too much seller credits. That just wouldn't make any sense.
And we're not in that market yet.
We're not in that market yet, exactly. So, all right, let's go down a little further here. Seller buy down. All right, let's see here. We already went over that. Keep going. Let's see here. All right. 5-1 arm. Okay, so a 5-1 arm is essentially an adjustable rate mortgage. Well, not essentially, it is an adjustable rate mortgage where the rate is fixed in for the first 5 years. So for 5 years, the rate won't adjust at all. However, if you don't refinance or sell the house after or in between that time period, it's going to turn into an adjustable rate mortgage that can fluctuate from 1 to 2 percentage points up or down, depending on where the market is. And it'll stay that way for the entire rest of the 25 years that they have the loan, if they keep it that long. So there is a difference there. That one is as a fluctuating interest rate after the 5 years. So you want to make sure that your clients do something. If they're only going to be in the house for 3 years, if it's a starter home, you know for a fact they're going to be out within 5 years. This would be a good product. But if it's their forever home and you don't know where the market's going to go, whatever the case may be, then you might want to steer clear of this, because anything can happen and you don't want them hanging out there after the 5th year with an adjustable rate that's just going to fluctuate with the market at that point.
Are they allowed to refinance in those 5 years?
Yes.
Okay.
Yeah. So if the market does drop within those 5 years and they refinance, they're good. So nothing happens. But they want to make sure if it is their forever home, they're going to want to make sure that they do refinance.
How long are the adjustables amortized? 30 years or? Yeah,
they're no, I'm sorry. After the 5th year, it's based on a 25-year term, because there's only 25 years left on it. So it's based on a 25-year term.
Okay.
And then after that, it'll be based on the year after, it'll be based on a 24-year and so forth. So
So in 30 years, if you don't do anything,
you'll pay the house off in 30 years if you make the payment, but your rate could go. I mean, there are 5% caps on it, which means it could literally go 5% higher than what the initial starting rate is. So even if you have a good starting rate of, 5%, essentially it could go all the way up to 10%, which is crazy. Nobody wants to be with a 10% interest rate.
Mhm.
So
the costs, the lender costs for 5/1 comparable to.
yeah, it's pretty much the same as a regular. It's just, once again, you're getting into the 5/1 arm gives you the ability to have a lower starting rate for 5 years than the current market rate. So I'll give the example of today, 6.5% is roughly where we are right now. A 5/1 arm is going to get you somewhere around 5.5%. So it gives you like a 1 point lower interest rate for the first 5 years, which is good. You just want to make sure you do something, either refinance the house or sell the house within 5 years. So you get out of that. You don't want to be hanging in there afterwards. That's it. So. Any other questions on that?
Nope.
Okay. 15-year mortgage, very straightforward. I mean, it's fantastic. It's going to save your clients a ton of money in interest. Literally, you can see the example right there. 15-year versus a 30-year mortgage on a $500,000 home saves $416,169 in interest. The only
That's astonishing.
that's a very large amount. The only thing is obviously with a 15-year loan, they're paying the house off in half the time. So the monthly payment is going to be double. Basically, it's going to be a lot higher. So if they can swing the payment, 15-year mortgage all day long, I recommend it for everybody because it's fantastic and it saves a ton of money. You get a lower interest rate. But once again, you just have to make sure that they can handle the payment. That's it.
What about, so if I can afford that, can you go back to the other slide? If, let's say I can afford the $4,008 payment.
Mhm.
But I'd like to be only committed to the 3160, so I don't have to, if next month is a tough month and I can't pay that extra $600, right? So if I took a 40, but I made, I'm sorry, a 30-year, but I made a payment of
A 15-year payment. Yeah.
every month. I know you don't have the answer now, but I'd be interested to know what the difference is by paying 4,000.
I can give you a pretty good estimate. So if you did that, if you took a 30-year loan, which a lot of my clients actually do exactly what you're saying, they don't want to be locked into that higher minimum payment due every month, but they want the flexibility of the 30-year so they can make those payments. And if something comes up, because something always comes up in life to where you need a little extra money for something, they want the flexibility of falling back on the 30-year payment if they need to, but still being able to pay it off early. So let's say in a hypothetical scenario, you got a 30-year loan, you made the 15-year payment every single month, you would actually pay the house off in 17 years instead of 15. So it add an extra 2 years on there, but still saves you.
But it gives you the flexibility, and
Right.
peace of mind to know that.
Right,
if I
exactly.
lose my job tomorrow, not locked into a higher payment.
Exactly. So that's another option. They're not going to pay it off in exactly 15 years like they would with the 15-year loan. They would probably pay it off in around 17, give or take, but they would still see, because anything above and beyond the minimum payment comes right off the principal, and then that re-amortizes the interest. So they would still save hundreds of thousands of dollars in interest doing that still, even that way. So once again, that's a great question. That gives them kind of the best of both worlds again as well. That's another way to do it. So absolutely good question. 40-year mortgage. So this
Don't
is
do it.
yeah, this is one. So you'll see in the example here, they give you a 30-year mortgage versus a 40-year mortgage. Literally the payment savings monthly is $35 a month. And that's on a $500,000 purchase price, $35 a month, but they have an extra 10 years to pay on it and a higher interest rate because the rates are higher in a 40-year loan. It's literally a waste of time. Don't even do it. Any lender out there that's talking about a 40-year mortgage, take it off the table completely because it's a waste of time and it does nothing for your buyers, plain and simple. That's my,
Perfect.
I mean, do you have anything to add to that?
No, good to know.
Yeah. All right. So let's go to the next one. Lock and shop. So Keller Mortgage has a lock and shop program that is amazing. Other lenders have it as well. It's a program where your clients can lock in at the date of application, go shop for a house, and then when they find the house, it's going to be based on either current market pricing or what they locked in at, depending on where the market goes. So most other lenders, they'll do a lock and shop for either 60 to 90 days max. They'll lock it in on their lock and shop program. And they'll also charge a fee. It's usually a couple $100 minimum to do that. We at Keller Mortgage lock in for 120 days and there's no fee with us. So
That's
once
great.
again, it gives them an added period to go shopping for a house. Once again, if they get under contract on a house, if the market is better at that point in time, we give them the better market pricing. If it's worse than when we locked in, they're locked into that and they get that pricing. So it's literally an insurance policy for your buyers to be able to shop and not have to worry about where the market goes. And we give them 120 days versus 60 or 90 with no fee.
Yeah.
It's fantastic.
Doing the new construction now that it's about a 4.5 to 5 month closing. And they're floating the rate right now. They could lock in at this
Mhm.
point where we're at a point where they could, lock in and let it float basically, right?
Yeah, so what Rick is saying here is that for new construction, it's fantastic because obviously there's got to be lag time for the house to be built. So instead of floating the rate and, kind of taking a gamble on where the market's going to be, the lock and shop program can lock them in and they can have the security and not have to worry about it.
That's
So
awesome.
it's great. All right, seller financing, I'm just going to touch on it briefly. You're never going to see it. If you have ever seen it, you may have seen it once ever. It's basically the seller acting as the bank, the lender. And it's not something that you're going to see often. I've been doing mortgages for 18 years and I've only seen it one time. And this was back in like 2010. So yeah, that's just where the seller acts as the bank. It's a really tricky process. It is useful if you know how to do it, but it's very rare and you're probably never going to utilize it. So
And more common like with investment properties, correct?
correct, exactly. So, all right, we can go to the next one. Trust deed wraparound mortgage. Once again, you're never going to see this one. I've literally never seen it in 18 years. It's pretty complicated where there's a lump sum payment that's given. The lender takes half of it or a portion of it, and then the seller takes a portion of it. And it's kind of, like a mortgage. It's complicated. So once again, if you want to know about that, call me. I can go into greater detail. I don't want to spend too much time on it because we're
No
limited here,
worries.
but yeah, you'll
Yep.
you'll more than likely never see it. Homebuyer assistance programs. This one you probably have experienced already. Down payment assistance programs, DPAs. So those are the programs like OFA and
Mhm.
whatnot, where you can put down as low as 1% to go there. The affordable first mortgage program and mortgage credit certificates. Mortgage credit certificates are something that they can get through. You have to get that approved through your city or your county. They give you a certificate for the interest that was paid and they pay it back to you. I haven't seen it yet. It's one of those things where I guess you would do in the background, the sellers would do in the back, or the buyers would do in the background. And there's a couple links on here that you can click on to learn more about those, but those are kind of few and far between. And that's it. So
Sorry, I feel like
No,
I'm
you're fine.
asking a lot of questions.
no, I like it.
So with home buyer assistance programs,
Mhm.
Do you guys work with outside, maybe it's not, I think it's considered an assistance program. I'm thinking Greater Circle Living. I don't know if you're familiar with that program.
I'm not.
It's if you live and work inside the Greater Circle area. So I do like physicians that would live in the University Circle area. They work at the clinic and they live in University Circle. There's a program that gives them, I think it's a $30,000 forgivable loan. So as long as they stay there for 5 years, that $30,000 is.
Yeah.
It's
It's almost like a grant.
loan.
It's like a grant, kind of
It's a
almost.
grant, yeah, they're getting a loan, so if they move in 2 years, they gotta pay it back. But I think it's 5-year program, as long as I'm there for
Mhm.
5 years, and as long as I'm still working for the Cleveland Clinic in 5 years, that $30,000 is wiped out. Is that a program or?
It almost sounds like that's
or-
something
or
that's,
Similar programs where you're getting grant money, would that be considered like an assistance program?
yeah, it sounds like so I've done a few of those recently within the last couple of years here, but they were, like you said, almost like a grant that's given through the city. It's not something that we actually control. They would have to apply for it and get it approved for the city to give that to them. And then it's used almost like as like a down payment for the house for them. I did like 3 or 4 of them in the last couple of years, and that's how it happened with them. I don't know if it's similar to what you're talking about, but it's money that they're given for the down payment through the city.
Right.
They use it to buy the house, and as long as they don't sell the house, within a certain period of time, that money is basically forgiven. And it's almost used as like a piggyback loan on top of it. It's like a mortgage that's forgiven after a certain amount of time. Does that sound similar?
Yeah, I think that sounds similar. So I guess the point is, or the question is that you guys, Keller Mortgage can work with those
Oh, yeah.
outside programs. It
Yes.
doesn't have to be a home buyer assistance program that's through, like OFA's through your bank, right? I mean,
Correct.
So this, you can work with those programs that are outside of NACA, I think is another one.
Yeah.
I've never used them, but I've heard about NACA. That's an outside
Mhm.
program that's giving assistance to home buyers.
Yes, so-
And you guys will work with those.
Correct. Yeah. So the, I don't know if anybody, if you can hear what he's saying, he's asking if Keller Mortgage works with outside companies and institutions that offer these down payment assistance. And yes, that's the answer is yes, that we do. We have the Homes for Heroes program that we offer. The physician's loan is actually coming down the pipeline here for us pretty soon. In the next couple of months, we're going to have the physician's assistance program, which is fantastic. It almost works like a VA loan with no PMI, up to 100% financing, which is great for doctors and whatnot. We do not have the OFA loan through FHA, the first time homebuyer through OFA. And the reason why, and a lot of people don't realize this and know this, but with the OFA program, the money that they're not putting down up front. So the difference between FHA's normal minimum of 3.5% to put down versus the OFA, which is 1%, that 2.5% that they're not putting down, if they refinance or sell the home within 7 years, they owe that money back.
Oh,
A lot of people
I
don't know
didn't
that.
know that.
Yeah, a lot of people don't know that. And
Another
a lot of
thing.
lenders don't really talk about that because it's obviously it's not a good feature.
Mhm.
And that's the reason why we don't offer it, because we don't want to lock our clients into a 7-year payback period. So.
Okay.
All right, understanding mortgage hacks for homeowners. So for your homeowners, there's things here, early payoff hacks. We talked about one of them with the 30-year versus the 15-year, making extra payments. A HELOC. Number 3, removing PMI, getting rid of the escrow account. That's pretty self-explanatory. House hacking, refinance to a shorter term mortgage and make payments with cashback credit cards. So these are all mortgage hacks for your current homeowners that you can advise them on what to do down the road. So I do want to touch briefly on these.
I was gonna say, yeah, like these are just a great touching point. Keep in touch with your clients, with your sellers. If you know, hey, your home value's gone up or rates are down, it's a great time to refinance. I also saw on there, HELOC is on there. And I actually think it might've been my last bold class. She said the equity in your home isn't doing anything for you, just sitting there as equity. So HELOCs are awesome if you want to purchase investment properties or whatever, and just being able to give that knowledge to your clients.
I agree completely. So one of the things you can tell them if they want to try to pay the house off earlier without killing themselves or stretching themselves too far with early payoff here, so they can actually make either one extra payment a year. Like they give the example of making one extra payment in January. One extra payment a year on a 30-year loan will pay the house off in 23.5 years versus 30 years. So they can cut off almost 7 years of the payment history by just making one extra payment a year, or they can split that one payment up into 12 payments monthly and just make a little bit extra a month. That equals out to one payment a year, and they can pay it off in 23.5 years versus 30 years. That's one hack that they can do, which a lot of my clients utilize because it's a great benefit. It's not going to stretch them too thin, and they can pay the house off and save a ton of interest on the loan. So let's go to the next one here. It kind of goes over the bi-monthly, which is what I just went over, taking that one extra payment a year of their mortgage, dividing it into 12 and just making that monthly. It equals out to the same thing and it gives you the exact same results. Rounding up the payment. The example here is if your monthly payments are $3,160, rounded up to $3,200, that extra $40 comes right off the principal, and you'd be amazed at what it does. And this example right here saves $32,483 in interest over the life of a mortgage by paying it off a little bit earlier and saving money in interest, which is amazing. It's only $40 a month and they save a ton of money. $1 a month plan, increasing the payment at $1, 900, 901. I mean, you could do that as well. It's kind of the same thing, just doing it a different way. So same thing there. Using surprise money bonuses. Obviously, I mean, that's something that they could do. You get a large commission check or a bonus, apply it to the principal. It's going to save you a ton of money there. I know a lot of people don't want to do that. They want to take the bonus money and go on a vacation, which I don't blame them. The HELOC, Joel touched on that. That's a great way to pull out your equity without having to do a full refinance. It's almost like a credit card that you can use. You can use as little or as much as you want. You don't have to take the lump sum out all at once. You can just kind of utilize it as you go. Do you have anything you want to add on that?
No, I guess a question I would have on that, if somebody they have a HELOC,
Mhm.
once you borrow from it, when you pay it back, does that bring your credit card balance up, or are you just purely paying that loan off?
Well, you're just purely paying that loan off. So if you have a HELOC, a line of credit, which HELOC stands for Home Equity Line of Credit. If you have a HELOC that has, a $20,000 available credit limit on there, if you borrow 1,000 on it, then you only have 19,000 available. If you pay that 1,000 back, then you still have that 20,000 available.
Okay,
So that's,
so it,
is that what you're
yeah, so
asking?
it
Yeah,
does
so
kind of go back and
it does, it
increase
goes
your
back. So
balance.
yeah,
Okay.
you still have access to the full 20,000 if you pay it all back. in that
Okay,
example,
so you
yeah.
could continue to, if you're an investor or something,
Correct.
that's a great.
Mortgage, Jesse? Do you guys do HELOC?
We do not.
Okay.
No, this is just something that a local credit union or a bank, a local bank, small bank, they're usually pretty good with the HELOCs. We don't offer them because it's it's just a niche market and there's really not, I don't know, we just don't offer it. So I don't know.
That next one, removing PMI, big
Mhm.
question. Does the PMI automatically come off, or do you have to contact your bank?
Both, actually.
Okay.
So it will automatically fall off if they don't contact the bank at all. Once the loan naturally amortizes below 20% equity, it'll fall off on its own. However, let's say you get into a loan with PMI and let's say 4 years go by and the value of your house has increased a lot to where you think you have a 20% equity position. You can, or whatever, it doesn't have to be 4 years, it could be 1 year or 2 years. You can call the lender and request that it be removed. They'll have you get an appraisal done to show the equity position. And if you're below 80%, they'll take it off and remove it for you. So you can get it removed even earlier than that if your equity position increases. So
Awesome.
very useful. Yeah. Getting rid of the escrow account, it's kind of like this right here. This hack is, to me personally, is almost kind of like a smoke and mirrors kind of thing, because yes, you're not paying your escrow through the mortgage. It doesn't decrease how much you have to pay because you still have to pay your taxes and insurance out of your own pocket. So
Mhm.
yes, your
And
mortgage.
that's a lump sum when that comes
Exactly,
to.
it's a lump sum, exactly. So yes, your mortgage payment will go down by quite a bit because you're not escrowing, but it's not like you don't owe the money, you still owe it. So
Yeah.
it's just a matter of preference.
I think that works well for high net worth individuals that
Correct.
are making more than just a standard checking account.
Yeah, or people that they get a huge bonus at the end of the year or throughout the year. If they want to do it that way, to keep their mortgage payments low, and then when they get the bonus check, they use that towards their escrow. I mean, that's good for them as well. So that's a good one as well. Living in the investment property. I know a lot of people that do this, they'll buy a duplex, they'll live in one unit, rent out the other, and you can offset your mortgage payment that way. I mean, that's
Mhm.
obviously a ton of people do that. It's fantastic.
And if you're going to live in it, am I right to say you don't have to put 25%
You
down?
are correct. Yeah.
So another advantage.
Yeah, and it's treated as your primary residence. You get better pricing, lower down payment amount, and everything's better. So it's great. Refinancing to a shorter term mortgage, that goes back to the 15-year loan. Once you're in a house for a little while, especially right now, buyers that are buying on a 30-year term right now, while rates are high, they're getting used to having to pay a higher monthly payment right now. So when rates do drop, let's say they go down to, high 3s, low 4s-ish. If they refinance, they can actually take a look at doing a 15-year loan or a 20-year loan at that point to shave off a ton of time and still keep their payments around what they're paying right now on a 30-year or even a little bit less still. And that's a great way for them to save a ton of money and get way ahead. So very good hack there as well. I go through that with all my clients when we refinance. I go over different terms and see what they're comfortable with. So it's a really good, useful hack. Making payments with a credit card. This is just if you have a credit card that has a lot of points or mileage that you want to use, make your mortgage payment with a credit card. You get the points and the mileage, which is an extra bonus. And then obviously you pay it off as soon as the bill comes in, and that's it. So,
Just not if you're a Dave Ramsey person.
exactly. All right.
You're taking mortgage if you're a Dave Ramsey person is.
Yeah, it goes against the grain with everything that he talks about. So
Weekly of cash, about $500,000 out.
I know exactly. It would be nice. So this last one, step 5, or not the last one, but one of the last ones, knowing the mortgage products your lenders offer. So we have with Keller Mortgage, we have all of the products, once again, all of the products for the most part that any other lender has. We just we make them a little bit better. I know the 2-1 buy down, the lock and shop. Obviously we have 0 lender fees with the 0+ loan and $1,000 credit on top of that. We save clients a ton of money, which is our bread and butter up front. So our products, I'll also send that out with the mortgage hacks playbook. So you have a good list of that and you can see.
And I would also add, you can keep going, Gara, but to know what your lender offers, you are going to sound smart to your client. So be privy to it, understand it, and then you're going to sound smart.
Yeah, and it's a good way when you do sound smart, like you said, when you're knowledgeable, people want to work with you because they feel like you're protecting them. So it's a really good, like I said, it's a really good thing to have in your arsenal for, especially in this market. Clients are scared to begin with because they hear about how high rates are and housing values and all that. If you come in knowledgeable and give them useful information, they're going to want to work with you, plain and simple. So market and advertise products and hacks. I mean, this is, put it on social media. Once again, another way to kind of get your brand out there and let people know that you're knowledgeable of what's going on. Put this on social media, put the mortgage hacks out there, put the different programs out there that are available so they can see it and they know that you know what you're talking about. So once again, they're going to feel like they're protected and that you're going to look out for their best interest.
If you could post your Friday financials, a quick 1-minute video of something lending.
Exactly. Market mortgage products and hacks to your database. So maybe you can speak a little more to this because this is talking about database and whatnot.
So I would just, like I said earlier, use this as an opportunity of reasons to reach out to your database. If, interest rates are going down, I hope you called everyone that's bought a house from you in the past few years and educated them on it. Just being privy to all of this, and it gives you a reason to reach out and to your contacts.
Yeah, and touch base. Keep your name fresh in their mind. It's great. All right, these are all case studies here. We don't necessarily have to. You can browse through this and you can look at some of the examples. We're not going to go over all of them with you, but you can see for yourself the total savings over the life of the loan with a lot of these, utilizing some of these products that we went over. It's phenomenal. It's going to save your clients a lot of money, put them in the best position possible. And if you want to work with somebody who has been through this a couple of times already, once again, I've been doing it for 18 years, utilize me. You have your mortgage lender, Keller Mortgage, that has your back, a knowledgeable loan officer and myself, been doing it once again for a long time. I've been through this market a couple of times already, so I know what to look for and what not to look for. And it's very important when you're dealing with your clients to make sure that they're in the best hands possible.
Absolutely. So we will email this out to everybody, and I really challenge all of you to read through it a few times, learn it so you can educate your clients. Do we have any questions from our huge class? Rick?
I've asked all mine.
Awesome. Well, we thank everybody. Matt, I thank you so much for sharing all this detail with us, and you know where to find them.
Yeah, thank you for having me.
Awesome.